Good afternoon, everyone. This is Jerry Winter along with Paul Cavanaugh with Future Path Trading. I'd like to thank all of you once again for your interest in taking the time to join Paul and I this afternoon. We're once again thrilled that we have been able to get John Ehlers to do another presentation for us. I know he's extremely busy, and it's great that he's gone out of his way to be with us here today. For those of you who have been with us before, this is Paul Cavanaugh, registered futures and options specialist. My name's Jerry. I've been with Future Path for 3.5, almost 4 years now. So, we're here to help you and answer any questions that you may have, and happy to do whatever we can for you. This is the standard risk disclosure statement. There is a substantial risk of loss in futures, options, and off-exchange foreign currency products. Past performance is not indicative of future results. Future Path LLC is a registered independent introducing broker with the NFA and CFTC. This may be an advertisement or solicitation for products and services. We've had quite a few questions about our World Cup program that we're offering with John Ehlers. And before we bring John in, I just want to spend a few minutes going over the structure of the leader-follower program. There's a lot of moving parts, a lot of entities involved. We want to make sure everybody knows who's doing what and why. Paul and I work for Future Path Trading. We're an independent introducing broker. Our role is to be the primary point of contact with the client, help you establish the account, help you get familiar with the products and services, and most importantly, help you as you move through the process and ongoing while you've got an account with us here. That is the case regardless of whether you're a self-directed trader, maybe using Photon Trader or one of the other third-party platforms, or if you're participating in something like the leader follower. We're here to get you started, get the account set up, and then help you along the way. The second part of the equation is the Futures Commission Merchant, or FCM. They're also known as the clearing broker. Their main function is to hold the client's capital, and that is held in what we call a customer segregated account. So Future Path Trading doesn't have anything to do with having your funds, controlling your funds. The FCM also provides the client with trading access to the exchange, and they handle all of the statements and online trading reporting services. Most of them have portals, online portals, where you can see your account balance, see the trades, in most of the cases in real time. Now, if we talk about the leader-follower program, you can see that it begins with the advisor on the left-hand side of the page. That is the role John Ehlers takes with this Mesa Ultra program. As I mentioned, he's trading his own account, and when he sends an order for execution, that order is sent to the associated futures exchange for execution, whether that's the CME or the ICE or whatever particular market that the advisor is trading. The World Cup advisor part, they provide the technology that allows the same trade that the advisor places to be duplicated and then allocated to all of the customers that have chosen to subscribe to the program. WCA World Cup also posts the trades to their website. So there is a track record, a recording of the trading activity for that particular day, and also in aggregate for the entire time that the program has been trading. Paul's going to get into that specifics in greater detail in just a couple of minutes. Another question that we get quite a bit is, what is the World Cup Leader Follower Advisor Program? What is it, and why would I want to participate in it? John went over many of the advantages of having a professional trader direct the trading activity in his last webinar, so I'm not going to spend too much time on that. But there are several other reasons why this particular program may be something unique. There's several different kinds of third-party directed accounts in addition to what we're doing here with the leader follower. The ones most often mentioned are commodity trading advisors, they're also known as CTAs, and hedge funds. There's quite a few specific distinctions, but I'm not going to get into that right now. The thing I want to emphasize in this case is that with the leader follower program, the advisor is directing his own personal trading account funded with his own capital at risk. That is a mandate from the WCA that anyone that is going to be an advisor does have to fund their own account, and they do have to trade it just like they would normally. That's not necessarily the case with either a CTA or a hedge fund. In many cases, the manager does have some money in the account, but you don't know how much. And in other cases, they may not have any at all. So anyone that's kind of interested in that particular aspect, this program does provide that. One of the other main advantages is that this program offers a level of transparency down to the actual trade by trade results, net of all fees, compiled from the time the program began. With CTAs, you get a monthly update. With hedge funds, sometimes the reporting is done quarterly, so there isn't as much information available on a day-by-day and even sometimes month-to-month basis. This leader-follower program does allow you to get set up and trading with relative ease. More importantly, maybe, you can also get out of the program very easily as well. There's no lockdown period, and all that needs to be done is to contact your broker, let him know that you'd like to move out of the program. We can take care of it, and then moving back in is very simple, same kind of structure. You don't need to fill out a bunch of new paperwork to get started again as you would in maybe one of the other programs if you've done a redemption. Finally, the suggested capital for participating in one of these programs that's managed by professional traders is typically less than what it would be with either a CTA or a hedge fund. Most CTAs have at least a $50,000 minimum and more typically $100,000 and above. Hedge funds, usually much higher, sometimes in the millions or in some cases tens of millions of dollars to get involved with one of those. So this was just a brief overview. There's a lot more that goes into it and a lot more that we can talk about. Please feel free to contact Paul and I if you have any questions about the structure, how to get started, what may be involved. We'd be more than happy to help you out, and our contact information will be put up at the end of this presentation. And I also want to invite you to type in any questions you may have along the way. We'll either pick them up on the fly or we'll take care of them at the end, and we can have John respond to those so you can get all of your questions answered. So I'm going to go ahead and turn the presentation over to John.
Thank you very much, Jerry. I'm going to begin the presentation with an excerpt out of my article in the September issue of Stocks and Commodities. And this is a graphic from that article. It shows the measurement during 2015 of SPY using the autocorrelation periodogram. And what we're doing is we're measuring the entire spectral content of the data. And the way the display works, along the right-hand side, the length of the period is shown on the vertical scale going from 8 to 48 bars. And the strength of the cycle period is shown as a color going from white hot to ice cold. So yellow is the strongest cycle period, and going through red hot down to black is ice cold. So that goes from strongest to weakest. So just glancing at the display back from the 30,000 foot level, you can see that there is more or less a persistent 20-bar cycle, a monthly cycle on daily bars here. And the other thing that is obvious is that the measurement, the appearance of the cycles, they're ephemeris. They come and they go. You see here this drop in August, the cycle period dropped dramatically down to a very short period. So there can be rapid changes, or there can be more gradual changes shown back here in April. So the cycle periods are measured pretty much all over the place, and it is a difficult measurement, as evidenced by the name called autocorrelation periodogram. So the way that this is done is the first step is to take an autocorrelation of the data. Now let's pretend that that data is a perfect 20-bar sine wave, the monthly cycle. So if we're correlating against itself, the correlation is 1.0, but if we slip one part of the wave compared to itself by 10 bars, then it's perfectly anti-correlated and we get a -1. If we slip the lag another 10 bars, so the total lag is 20 bars, the waveform of a 20-bar cycle is back in perfect correlation with itself. And so the correlation function swings from a maximum of +1 to a minimum of -1 back to +1 again. So that shows the periodicity. The important thing is that the amplitude always swings between a maximum of, it's bounded between -1 and +1. And once we get the periodicity in terms of an autocorrelation function, then the periodogram part is a discrete transform to make this display that you see. Well, that's a lot of work, and it's a difficult measurement to make, and there is a reason why it's done that way. Here I show you two charts. One is daily on the right, and the other is a weekly chart. They look very similar in their structure, but there is a major difference. We've removed both the horizontal and vertical scales. So if the weekly time frame is 5 times larger than the daily time frame, that implies that the vertical scale must be 5 times larger also, since the two charts look similar. So the perfect vertical and horizontal scaling goes hand in glove. What that means is that the longer cycles are in proportion to their period. That is, the longer the cycle, the bigger its swing. And now that becomes a problem for trading systems and indicators. And I call this this effect where the cycle period of market data gets stronger in direct correlation with the period, spectral dilation. The amplitude gets larger and larger as the period gets longer. And in fact, what happens with most indicators is that these longer cycles swamp out the effect that you're looking for. For example, in your stochastic, in an up market, I'm sure everybody notes that the stochastic looks like it's pretty much stuck up against the upper level. And in a down market, the stochastic is stuck pretty much against the lower level. That's the direct influence of spectral dilation on an indicator. And in order to handle particularly swing trading or reversion to the mean kind of trading strategies, you have to mitigate that spectral dilation effect. So that's one major requirement posed for a good indicator and trading system. A second requirement is that we're dealing with sample data. We get one sample per day on daily data, or one sample per minute, or one sample every 15 minutes. But nonetheless, it's sample data. And a necessary artifact of sample data is that you can encounter aliasing. Aliasing, in a visual sense, can be thought of as watching the wheels on a stagecoach turn backwards in the old cowboy movies when they had flicks sampled at 16 frames per second. The sample rate couldn't keep up with the spoke movement, and so they appeared to look backwards. Or another example of aliasing are dancers that use a stroboscope. They get weird effects and fantastic visual effects, but these are false images produced simply by aliasing. So because we have sample data in the market, regardless of the time frame we're on, or even if we're on equitick bars, they're still samples, and we must remove aliasing. By the way, I recommend my Super Smoother filter for that. That's a good way to get rid of most aliasing effects. Third minimum requirement for signal processing is that computational lag must be minimized. For example, I see a lot of people using a 50-bar moving average. Well, the lag of a simple moving average is about half its length. And so you're looking at a 25-bar lag on a 50-bar moving average. That's like reading last month's newspaper. It just simply doesn't work, particularly for intraday and swing or reversion to the mean technology. And finally, here's the thing that a lot of people miss. The trading signals must be predictive. What was the last time you saw somebody talk about the predictive nature of an RSI? They tell you what it does and how it swings, but they don't tell you what it's going to do as far as going into the future is concerned. And so that is a significant point. If you stop and think about it, any trading signal is a prediction of what's going to happen within the duration of the next trade. And so being predictive is particularly important. Well, I do prediction in a unique way. Here is an example of the technology. I have shown a perfect theoretical 20-bar sine wave as the data bar. The indicators, there are two indicators below in the first subgraph. The first indicator I'll call a cycle indicator. It takes the shorter period of the spectrum and measures that. And you get the gray bars, and I've flagged the cycle minimum with the green bar and the cycle maximum with the red bar as soon as I can identify it, which is usually 1 bar after it actually occurs. But note that those green bars occur about 3 bars ahead of the true minimum value of the price data. And by the same token, the red bars occur about 3 bars before the absolute peak of the price function. So it's a leading function by taking the fast or the faster or shorter cycle period part of the spectrum. But I can double the signal to noise ratio of my strategy if I use a different independent piece of the spectrum. And I do that with this cyan line called, I'll call that a momentum line. This is more like a traditional stochastic. And you notice that it tends to be, because it's tuned to the lower part, the longer wavelengths, it gives a lagging function. And so we can make trading signals from these two. And the trading signal for a buy signal would be buy after you get a green bar or cycle minimum on declining momentum. And you see that is predictive. We're making that prediction in ahead of the cyclic turning point. By the same token, the signal for a short signal would be sell short when you see a red bar or a cycle peak on maximum, increasing or maximum momentum. So that is the beginning of the rule set that is predictive in nature of the trade to come. So the next step is going from we have to go from indicators into trading strategies through rule sets. Now the rule set I've shown here diagrammatically as an indicator. Basically it means if this red line is low, we want to be short, and if the red line is +1, we want to be long. So a crossing of the 0 lines constitutes a buy and sell signal. So starting at the left-hand side of the chart here, we cross a 0 at the open of the day. We go short and stay short. This is the end of the day right here. So we stay short and get out at the end of the day. We wait on the next day until we go long here at, I'm eyeballing this, about 8:30, and we stay long the rest of the day. On the next day, and then we get out, of course. We're always out at the end of the day. The next day, we start to go short at about 7 o'clock in the morning. This is West Coast time, by the way. And I hold that short all through the day. On the next day, we don't get a crossing until about 10:30 in the morning. We go short on that 0 crossing and hold that short for the rest of the day. The next day, we go long at about 7:45 and hold that long position for the rest of the day. So that, by converting the indicator to trading signals through a rule set, we get a cohesive way to trade intraday and not overtrade. And that's basically the technology involved with Mesa Ultra ES. Mesa Ultra ES ES is a 100% algorithmic trader. You see the complete rules. There is no discretion, no emotion to it at all. It uses 15 minutes of data bars on the S&P E-mini futures contract. That's the ES symbol. And the trades are automatically placed. Jerry showed you the schematic of where the advisor places his trades. The trades go from my computer, which happens to be in the cloud, and they're automatically transmitted. I don't touch a thing. And the reason my computer, I have a virtual computer in the cloud, is because that way I avoid internet failures and PowerPoint failures that I could experience here on my home machine. And these are the kind of things that I worry about, single point failures. So we try to avoid single point failures. What happens as a result of that, and using our technology, we trade usually about once a day, sometimes twice a day. But one of the most important things is that we do not optimize, ever. Mesa Ultra ES will never be optimized. Let's stop and think about what optimization means. First of all, it's an absolute misnomer. Let's do a thought problem. Let's suppose we have a trading system that has 2 or 3 or 4 parameters, and we want to optimize those parameters. Well, we're doing a combination search that produce the best results. And just for thought, well, let's assume that the lowest profit we get out of any combination is 0 profit, and the maximum profit is $1,000. So we got 10,000 combinations spread along the horizontal axis between 0 and $1,000. There is one, and precisely one, combination that produces $1,000 profit. So where do the other combinations fall? Well, conceptually, it's going to be, in the statistical sense, it's going to be a bell curve. And with luck, it's not going to be skewed. It might be about halfway in the middle. So that's where the bunch of combinations are that are going to produce the average results. And the probability, here's another way to view it. The probability of getting that optimized value is 1 in 10,000. If you're trading once a day, that's 250 trades a year. So 250 trades into 10,000 combinations is a lot of years before you ever expect to see that combination perform again. So that's so optimizations are to be avoided, and we do that. And the reason we can avoid them is that our algorithm is robust. We know that it's robust because we've traded it across 4,000 stocks and ETFs and futures. We know it's robust over time and market conditions because we've used 20 years of backtesting in all of those markets to develop the algorithms and the rules. And it's robust over the data sample rate. It works anywhere from 1-minute bars to daily bars and everywhere in between. So it is robust and does not require optimization. Here's the brand new news. I have a brand new offering called Mesa UltraYM. It's the similar structure to the Mesa Ultra ES, working on the E-mini DAO. The E-mini DAO is a smaller contract. The YM contract is smaller than ES, which enables us to lower the capitalization required to $10,000. And that has a couple things in its favor. It makes it easier for entrants, and it enables portfolio diversification. For example, those people that started with Mesa Ultra ES could simply roll their profits after 4 months into the Mesa Ultra YM and get a portfolio of two futures contracts. Now, there is a significant advantage of trading a portfolio of futures contracts, and I will show you this by on the data I have comes from our StockSpotter program. Here this is measured data that we have for just this week. If we look across, we have about 10,000 trades in our database. And so what we have done to create this bell curve is we go back into those actual trades and randomly pull them out to get a year's worth of trading. And then we repeat that random drawing 50,000 times, and that's what creates this bell curve. Now, the result of that, we were assuming that we have $10,000 on every trade, and if over a year, that means that we've made 23.4% profit, which is pretty good for stocks because they're not margined at all. Now, I want you to remember that number, 2340, our Sharpe ratio, which is the mean divided by the standard deviation, and the probability of break even is 76%. There is a principle of statistics that if we double the members of the ensemble, we cut the standard deviation by the square root of 2. So in StockSpotter, if we go to double that again, we're going to cut the standard deviation in half. But we split our $10,000 4 ways, we still get the same average profit trading 4 symbols simultaneously in a portfolio. But we double our Sharpe ratio. We double the Sharpe ratio because we kept the most likely profit the same, but we cut the standard deviation in half. And another ramification of trading a portfolio is that we've gone from probability of exceeding break-even from 76% to 94%. We've done that because we skinny down the bell curve. We made it more narrow. What it means in another way of viewing it is along your equity growth curve, you've reduced the standard deviation from the average profit per trade. And so trading a portfolio that you could now do with a Mesa Ultra ES and a Mesa UltraYM is kind of an important aspect to improve your probability of success in trading. So that's, I'd like to, at that point, I would like to move from talking about the leader-follower program to the workshop that I have coming up here at the end of October. It's running from the 28th through the 30th of October here in San Simeon, California. It's going to be easy. If you have high school algebra and trigonometry, that's all you need, and we'll be working through the details. I will ask that you sign a non-commercial NDA because I'm going to fully divulge my Mesa intraday and my Mesa phaser programs that I sell for $3,000 a piece, and I simply don't want to compete with myself on the commercial market. So there's an NDA for those items, as well as the Mesa algorithm itself. The cost is $6,000, which is pricey, and I guess the reason why is it so expensive, and the simple answer is because it's worth it. I'm going to go into the spectral structure of the market like I touched on today. We'll go into that to detail to fully establish the requirements for trading systems and how to use the DSP to attack them. Then what you're going to take away from that is an understanding of the market action. You'll get my Mesa algorithm, and you're going to get a full set of indicator codes disclosed and all of my recent robust strategy codes that I've been working on for the last 10 years. So you can read more about that if you go to mesasoftware.com #workshop, and that will take you right to it, or you can just go to the home page and scroll down. This is a list of the indicators that I call really indicate. Bandpass filters, dominant cycle versus the Pisarenko harmonic decomposition. I'm using a modified covariance matrix, which is kind of interesting. Decycler oscillator. Decycler filters are a really low lag way of getting trend following if you want to do that. A unique Filt11 technology is there. I'll show Spearman correlations. The super smoother I talked about to get rid of aliasing effects. Automatically adjusting and adapting waveforms with the synthetic sine wave. Now that's important because it converges immediately. Other adaptive techniques have a relatively slow convergence, and then you saw if the cycles are moving around like they did in the initial measurement I showed you, the slow convergence techniques simply don't work. So I'm also going to show absolute unique strategies that are not published. Here is a list. The Mesa phaser, Mesa correlation, error correcting codes, the synthetic sine as a daily strategy, and there are other unique features that have to be overlaid on those to make intraday strategy worthwhile, including the synthetic sine, specifically for intraday work. So that will be, I would love to have you all attend, or it's going to be in small and intimate group. I'm limiting it to 20. There's a few seats left. So if you feel like you would like to come out and work with me in an intensive one-on-one basis for 3 days, this is the time to do it. I've only given one other workshop in my entire life, and I don't expect to do this again. So this is kind of a once-in-a-lifetime opportunity. With that, I would like to turn it back to Jerry. If you have any information that you want to get about trading or opening account, talk to Jerry or Paul. Their phone numbers and emails are here. Or if you have technical questions, you want to talk to me about the workshop, or you want to talk to me about something specific to technology, you have my email and phone number as well. I'm here in the office generally from 9 to 4 o'clock West Coast time. So Jerry, if you're there.
We are, and thank you very much for your presentation, John. This is Paul Cavanaugh, and Jerry's here with me. We just want to wrap it up with any questions that you folks have for Mr. Ehlers. You could type them into the chat or questions panel, and I will do my best to have those answered. If we do not get to them, we can follow up with them with you by email if your question is typed into either the questions or the chat panel. So briefly, I'm just going to show you, I've had a good experience working with customers that are trading this World Cup Advisor program, John Trades. So let me just see if I can share my screen here for a moment. And what I wanted to do is just tell you a little bit about my experience with opening up customer accounts that are now trading this method in this particular program. As a broker with 25 years experience in the industry, I've seen a lot of traders come and go and kind of behave randomly. What's neat about this system is that it trades 100% algorithmically, and it trades most days. It's also, I've found, just from the small sample I have of a few months trading it, it seems to perform very well when we have volatility. And it's my opinion that coming into this election, we'll have uncertainty and volatility. And so from my perspective, or in my opinion, I think it's a good time to be involved with the Mesa UltraES program. Customers that I've put in the program and assisted with that, it's been a good experience for me, and I'm interested in promoting it, as is Jerry. So what I want to do is kind of just show you some of the resources and what you can do to learn about it in the meantime. Jerry and I will follow up with you folks with a letter that shows you the links to this performance data and how you can get access to that.
but basically you can go onto the World Cup Advisor website and be able to look at the current positions. So this is what this is going to show here. I just clipped these together so I wasn't jumbling around on a web page while I'm trying to show you these. So this was an open position this afternoon. We're at 3:15, so the position's been closed out. An example of a closed out trade. You see there's these different tabs on their website. You'd be able to click on open positions through the day and see how the trading is going. You can click through closed positions and go through 6 to 8 pages of closed out trades that have occurred over the last 4 months. So you can go through and look at these trade by trade. You can look at and this is what Jerry was talking about to some extent with the transparency of this program. You can see if you're in a position in just about real time. You can also review what has been traded. That's something that we're happy to sit down with you and go over the trading to make sure you're comfortable with it. You need to be using risk capital, money you can afford to risk that won't change your life if you're going to be trading in the commodities markets because of the high degree of risk. But this is a very good approach, in my opinion. Something I'm interested in promoting because it's traded by a professional and has been set up by a professional with a very good name in the industry, especially in systems. He's an expert. Here's just a little window that shows it again, and some more information about this, and then I just want to tell you how to get started if you choose to. Methodology is cycle and trend. As we said, it's been running just over 4 months. An initial $15,000. The peak to valley drawdown between the 31st, during the month of August, if you will, from the end of July to the end of August. What happens when you get involved with a program like this is that you open an account with our clearing partner, as Jerry said, an FCM or Futures Clearing Merchant. Then we send you additional documents which allow your account to follow Mr. Ehlers' account. Once those are all submitted, you would get an email saying your account's been added. The next day you would most likely see a trade occur in your account, as you would on the website. So it's not too difficult, but it does involve a couple of steps. The first thing that we do to help you folks get started is give you a link to our clearing partner where you can go and process an online application. Then you notify us that you've done that, submitted that form, and we can then give you the additional documentation that allows your account to follow Mr. Ehlers. But then on a monthly basis, what you're being charged for the management of your account is $200 on a per contract basis subscription fee. Basically, that's how the advisor gets paid. This doesn't involve, as Jerry was talking about CTAs, it doesn't involve paying a management fee or paying a percentage of your profits. So that's an advantage to this program in our opinion. So hope that helps. I can see a question for Mr. Ehlers here, so let me unmute him. From your books, what over time proved wrong or showed not the needed edge, and what would you see as the 1 to 2 most valuable findings, studies, or indicators?
Whoa.
That's quite a question.
Yeah. Let me pause and think about that.
Okay.
If I stop beating my wife. Well, I have to separate technology from trading, actually. I've learned lots of things about trading, but I'm not, like really respect leverage. That's one of them. Now, and in the old days, there were such things as limit moves, and you get locked into a position and for 3 or 4 days in a row, and you couldn't get out of it.
Sure, I remember.
And you can see, yeah, that hasn't happened very much lately, but that's not to say it can't happen. So have respect for what leverage can do. It can work in your favor, and it can work against you just as well. So that technology, I think it lies in the Mesa algorithm itself. I jealously guard the Mesa algorithm because I spent years back in the days in the 1980s, in the late 1970s when I started developing it, the Fourier transforms I knew were dead wrong for trading market data, but I didn't really appreciate this concept of spectral dilation, the fact that the longer cycles are stronger. And what that did in the early days was I was measuring longer cycles and they were impacting the trades made in the shorter sense. So what I've learned to appreciate is how to mitigate spectral dilation. I have developed a match filter, for example, that I'll be talking about, that statistically eliminates it and evens out the spectrum so that all cycles are playing on the same level playing field. And that's made swing trading or reversion to the mean perform much better. And in that regard, how do you evaluate performance? I've learned to appreciate the statistics of the number of consecutive losers. That happens a lot, and then it's a higher percentage than you might imagine. In evaluating the performance or in the development of trading systems, I put a really, really high percentage, weight on percentage winners on historical performance. Because if it didn't work to a high percentage in the past, it's not going to work in the future. And that's a key element in evaluating how a given trading system is going to work. All you have to work with is past data, and higher percentage wins has had a great influence on my thinking. It's led me to, when I started, I was trading grains and meats, particularly soybeans and corn, and I was trend trading, frankly. But now I've come to learn that trend trading involves hitting a home run every now and again, but you get a lot of pop-out flies in the process. What that means is you take a little bite and you get a loser. You take another bite and you get a loser. And you take another bite and then you hit it big, but your percentage wins are down, and you may have a successful system with only 30% wins, but in the long run, I don't think that's robust. If you're a trend trader, you're basically relying on the bias in the market. There's been a significant up bias in the stock market. And if you're trend trading, and you're probably trend trading to the upside, and you're just taking advantage of the bias, in my opinion. So that's evolved me into strategies that are reversion to the mean. When I get a swing away from the mean, I know the statistics are in my favor that it's going to revert and go back somewhere to the mean, both to the upside and to the downside. So that's a long explanation of a pretty significant question.
Well, thank you very much, Mr. Ehlers, for that. And I'm seeing that the individual who asked the question is also saying thank you very much. I appreciate your answer there. We are, at this time, out of time. So I want to thank Mr. Ehlers sincerely from Jerry and myself here at Future Path Trading. We want to thank you folks for being here with us today. We did record the webinar. We will send out a recording to all the registrants from our last 3 webinars over the next couple of days as time permits. Mr. Ehlers, thank you very much for your presentation today. We appreciate it, and we look forward to working with you again in the future.